Exercise 1.22. The information relates to Minute Limited for the year ending 28 February 2025. The company sells inventory at a profit margin of 500% on cost price. Required 1.22.1. Calculate the missing information and amounts in the Statement of Comprehensive Income or Income Statement for the financial year ending 28 February 2025. 1.22.2. Show the following notes to the Statement of Financial Position, the ordinary share capital note, and the retained earnings. 1.22.3. Complete the equity and liability section of the Statement of Financial Position on 28 February 2025. Show all calculations. Information 1. Extract of amounts on 28 February 2025 for ordinary share capital, retained earnings, loan ABSA, trading inventory, debtors control, provision for bad debts on 1 March 2024, creditors control, rental income, stationery, directors fees, audit fees, and sundry expenses. Number 2. Adjustments and additional information on 28 February 2025. 2.1. Provision for bad debts must be adjusted to 5% of outstanding debtors. 2.2. A physical inventory count shows the value of trading inventory on hand as 160,000 Rand and stationery on hand as 1,500 Rand. 2.3. A debtor requested that the debit balance of 1,240 Rand in the debtor's ledger be carried over to his account in the creditor's ledger. 2.4. Rental income includes the rent for March and April 2025. An increase of 10% came into effect on 1 January 2025. 2.5. The following statement was received from ABSA relating to the loan. Balance on 1 March 2024, 500,000 Rand. Total repayments during the year including interest, 175,000. Balance on 28 February 2025, 380,000. Interest on the loan is capitalized and the capital repayments will remain unchanged for the following financial year. 2.6. Income tax is calculated at 30% of the net profit before tax. The provisional tax payments for the year amounts to 220,000 Rand. 2.7. Share capital and dividend. The company has authorized share capital of 1 million ordinary shares. On 28 February 2025, 700,000 shares were in issue. On 1 May 2024, the directors issued 200,000 shares at an issue price of 720 cents per share. On 31 May 2024, an interim dividend of 34,000 Rand was paid. On 1 January 2025, 150,000 shares were bought back at a repurchase price of 650 cents per share. On 28 February 2025, a final dividend of 5 cents was declared on all issued shares. 2.8. The percentage operating profit on revenue obtained is 45% for the year ending 28 February 2025. 1.22.1. Statement of Comprehensive Income for the year ending 28 February 2025. Our revenue is given as 2.1 million Rand. And in the beginning of the question, they say the profit margin is 500% on cost price. So to work out the cost of sales, we're going to take our revenue of 2.1 million and we're going to say times 100 divided by 600. And that's going to give us 350,000 Rand. And that'll be in brackets because it's an expense. So our gross profit will be 2.1 million minus 350,000 to give us 1,750,000 Rand. Other operating income, we're going to start with our rental income. If we go to adjustment 2.4, rental income includes the rent for March and April 2025. An increase of 10% came into effect on 1 January 2025. So obviously, if it includes March and April, it means we've received rental income for 14 months. But from the 1st of January, it increased by 10% the monthly rental. So we first need to make an equation to calculate the X. So we know for 10 months it was normal, plus for 4 months it was the increase of 10%, to give you a total of 216,000 Rand as per information 1. Then you calculate X as 15,000 Rand. So the increased rental, what is 10% of 15,000? 1,500 Rand. So our new rental income that we received is then 16,500. We received that for 2 months in advance. So 16,500 times 2 will give you 33,000 that we will subtract from our rental income. So 216,000 minus 33,000, our rental income that we received should only be 183,000 Rand. Then next we will look at adjustment 2.1. Provision for bad debts must be adjusted to 5% of outstanding debtors. So we go to our debtors control. Our debtors control is 67,000. We times that by 5% to give us 3,350. And then if we go back to information 1, the provision for bad debts that we provided for is 3,600. So there will be a decrease of 250 Rand, which makes it a provision for bad debts adjustment income account of 250. So it's 3,600 minus 350, and that gives us 250. Then we'll consider whether we've got a trading inventory surplus or deficit. If we read 2.2, a physical inventory count shows the value of trading inventory on hand as 160,000 Rand. If we go to information 1, our trading inventory is 154,000. So in other words, we are going to have a trading inventory surplus, 160,000 minus 154,000, and that will give you an answer of 6,000. So our other operating income, if we say 6,000 plus 250 plus 183,000, will give you 189,250. So our gross profit of 1,750,000 plus other operating income of 189,250 will give us a gross operating income of 1,939,250. Then to calculate the operating expenses, our directors' fees remained the same, 380,000. Our audit fees remained the same, 481,639. Our sundry expenses will be our balancing figure, and now let's just account for stationery. If we go back to adjustment 2.2, stationery on hand was 1,500. So then it means of the 23,000 that we paid according to information 1, 1,500 is still on hand, so we need to subtract that from the 23,000 to give you 21,500 as your expense for stationery. For the operating profit, adjustment 2.8 says the percentage operating profit on revenue obtained is 45% for the year ending 28 February 2025. So we know our revenue was 2.1 million rand. If we times it by 45%, then we get 945,000 rand as our operating profit. So then to calculate your operating expenses, we're going to work backwards. We're going to take the gross operating income of 1,939,250 and we're going to minus the operating profit of 945,000. And that's going to give us an answer of 994,250 in brackets because it's an expense. For the sundry expenses, then we work backwards to calculate that figure. So it'll be our operating expenses minus the director's fees, minus the audit fees, minus the stationery to give you 111,111. To calculate the income tax, you go to adjustment 2.6 and they say the income tax is calculated as 30% of the net profit before tax. So the net profit after tax is 672,000. You then work backwards. So you times by 30, divide by 70 to give you 288,000 in brackets as it's an expense. So your net profit before tax will then be 672,000 plus 288,000, and that's going to give you 960,000. For interest expense, we go back to adjustment 2.5. We are going to take the opening balance minus our total repayments minus our closing balance. So to do that, it's going to be 500,000 minus 175,000 minus 380,000, and then that's going to give you an answer of 55,000 as your interest expense in brackets. Your profit before interest expense, you work backwards, so we're going to take the 960,000 and we're going to add the 50,000. And that's going to give us 1,015,000. And your interest income, we're also going to work backwards. It's going to be the 945,000 minus the profit before interest expense of 1,015,000 to give you 70,000. 1.22.2. Show the following notes to the statement of financial position, our ordinary share capital note. So if we go to adjustment 2.7, the company has authorized share capital of 1 million ordinary shares. On 28 February 2025, 700,000 shares were in issue. So at the end of the year, we have 700,000 shares in issue. Then they say on the 1st of May, the directors issued 200,000 shares at an issue price of 720 cents. So we're going to have 200,000 shares issued during the year, and 720 cents will be 7.20 Rand per share. So 200,000 times 7.20 Rand gives you 1,440,000 Rand. Shares bought back on 31 May. An interim dividend of 34,000 was paid, and on 1 January 2025, 150,000 shares were bought back. Okay, so we'll have 150,000 in brackets because we bought the shares back. And remember, when we purchase shares back, we have to record the average share price. So to calculate the average share price, it's our ordinary share capital divided by the number of issued shares at that date. So at that date, it's 4.2 million Rand divided by 700,000 shares to give you 6 Rand per share. So it's always bought back at the average price. In this case, is 6 Rand per share. So 150,000 times 6 Rand gives you 900,000 in brackets. And then if we read further, at the beginning of the year, what was our shares that we had at the beginning of the year? Well, that will be our balancing figure. We'll work backwards. So we'll say 700,000 minus 200,000 plus 150,000. And that gives you 650,000. And then we do the same with our amount. So 4,200,000 minus 1,440,000 plus 900,000, because you work backwards, gives you then 3,660,000 Rand. Retained earnings, balance at the beginning of the year. This, once again, will be your balancing figure. So we always start with our net profit after tax. And it was given as 672,000. Then we're going to have our repurchase of our shares. If we go back, we repurchased 150,000 shares at a purchase price of 650 cents. So 650 cents is 6 Rand 50. Now remember, the difference goes to retained income. So our 6 Rand 50, 6 Rand was our average price that goes to ordinary share capital, and 6 Rand 50 minus 6 Rand, which gives you 50 cents, goes to retained earnings. So we are going to have 150,000 shares at 50 cents, and that's going to give us 75,000 Rand in brackets. Our ordinary share dividends, our interim dividend was given as 34,000 Rand. And our final dividends on 28 February 2025 was declared at 5 cents per share. So at the end of the year, we had 700,000 shares at 5 cents per share to give you 35,000 Rand. So our ordinary share dividends will be 34,000 plus 35,000 to give you 69,000 in brackets, because it's an expense. So then we work backwards to get the balance at the beginning of the year. So 743,000 minus 35,000 minus 34,000 plus 75,000 minus 672,000. So you work backwards. So all the negative figures becomes positive, and then 672,000 you minus. And then you get an amount of 215,000 Rand as your balance at the beginning of the year. (1.22.3) Complete the equity and liability section in the Statement of Financial Position or balance sheet on 28 February 2025. Show all calculations. So our equity and liabilities, we start with our shareholders' equity, and that consists of your ordinary share capital, which was 4.2 million Rand, as well as your retained income, which was 743,000. So the shareholders' equity will be the 4.2 million plus the 743,000 to give us 4,943,000. Then our non-current liabilities, we must first determine what part will be short-term and what part will be long-term of our loan. Okay, so the loan repayable within 12 months, if we go back to adjustment 2.5, our balance at the end of the year is 380,000. Our balance at the start of the year was 500,000. So it means 120,000 will be repayable within the next 12 months. So in our non-current liabilities, we have a loan from EBSA. We will say 380,000 minus the 120,000 that's going to be payable within the next 12 months to give you 260,000 Rand. So our non-current liabilities then adds up to 260,000 Rand. For our current liabilities, we can start with the loan payable within 12 months, which we know is the 120,000 Rand. And then we will have our trade and other creditors. To calculate the trade and other creditors, we take our creditors control amount. If we go to the information 1, creditors control is 42,240. Then we are going to go to adjustment 2.3, where we have to transfer debtors balance to the creditors ledger. So we are going to minus that debtors balance of 1,240 Rand. We are also going to add back our income received in advance from our rental income, the 33,000 that we calculated from adjustment 2.4. And then we have to work out a provisional tax due that we add back. I will show you how we're going to do that. And then we also add back our final dividends declared of that 35,000 Rand that was declared but not paid. So it means it's still accrued, it's still owing. To calculate the provisional tax due, if we go to adjustment 2.6, our provisional payments was 220,000, and our income statements, if we calculated the income tax, it was 288,000 that we should have paid. We only paid 220,000, so it means 68,000 Rand is still due. So then your trade and other creditors will then be calculated as follows. It will be the 42,240 minus 1,240 plus 33,000 plus 68,000 plus 35,000, and that will give you 177,000. So 177,000 plus 120,000 adds up to your current liabilities of 297,000. So that then means our total equity and liabilities will be our shareholders' equity plus our non-current liabilities plus our current liabilities added together to give you 5,500,000 Rand.